All right, today we're tackling a huge topic in retirement planning. It's this idea that you can add one special type of stock to your portfolio and, like magic, dramatically boost how much money you can safely spend every single year. So we're going to dig into the data and see if this promise actually holds up under pressure.
So this is really the big question, right? Can a simple little tweak to your investments seriously take your safe withdrawal rate from that classic 4%, the rule of thumb we've heard for decades, all the way up to 5%, maybe even 5.5%? Some folks absolutely swear by it, but the analysis we're looking at today takes a much more skeptical approach. Let's follow the investigation.
Now, you got to admit, if you only look at the past, the idea is incredibly tempting. The asset class we're talking about is small cap value stocks, or SCV for short. And when you just run the numbers based on historical data, adding them to a retirement portfolio seems to work like an absolute charm. It looks almost too good to be true.
And, just look at this. The historical results are shockingly consistent. This table here compares a simple 75% stock, 25% bond portfolio to one where half the stocks are swapped out for small cap value. And wow, across every single historical decade, the safe withdrawal rate goes up. For someone who retired right before the Great Depression in the 1920s, it jumps by over a full percentage point. That is a life-changing difference in retirement income.
So based on that last slide, you're probably thinking, okay, time to overhaul my entire portfolio. But not so fast. This is where the author of our source material hits the brakes and asks a really crucial question. Is the engine that drove those incredible historical returns still fired up, or has it started to sputter out?
Okay, so let's break this down, starting with the small cap part of the equation. As you can see from this timeline, the outperformance of small stocks, it really only had two big surges. You had one in the 30s and 40s and then another one in the 70s. But since the early 1980s, well, for about 45 years now, it's been kind of flat. The author basically asks, where's the next big rush going to come from now that everyone knows about them?
And you know what? The story with the value factor is even more dramatic. From 1926 all the way to 2006, it was a beautiful picture. Value stocks would dip, sure, but they always recovered to new highs. But then, it's like someone just flipped a switch in 2006. Since then, the trend has been relentlessly downward, just this frustrating pattern of lower highs and lower lows.
So this all leads to the author's central point, the core of the whole argument. The secret's out. That massive, reliable outperformance, what the pros call alpha, it happened back when not many people knew about small cap value. Now that it's a mainstream idea, that free lunch has probably been eaten. Expecting those same huge returns going forward, it's just not realistic.
And this brings us to the author's stress test. I love this part. If we can't count on those giant historical returns, what happens if we simulate the future a bit more realistically? So the author strips out what they call the ill-gotten historical average returns to see if SCV can still pull its weight.
And yikes, this table really tells the story. When you take away that historical magic and just assume SCV performs like the rest of the market, zero alpha, the whole picture flips on its head. Look at what happens in the absolute worst times to retire, like 1929 or 1968. Adding SCV actually lowers your safe withdrawal rate. You end up with less retirement income, not more. The author has this fantastic term for what's happening here, diversification. It's what happens when you try to diversify by adding something new, but because it brings more volatility without enough extra return, it actually makes your retirement outcome worse, especially when you get unlucky with your timing.
Okay, so what if we're not so pessimistic? What if we add back a small, modest performance boost for SCV, something based on projections from a big firm like Vanguard? Well, even then, the results are deeply underwhelming. In the riskiest times to retire, your safe withdrawal rate is still lower. It doesn't help. The big takeaway is clear. Even a realistic boost isn't enough to get you to that miracle 5% SWR. Now, let's look at a case study of this in action. There's this popular, pretty complex portfolio called the Golden Butterfly, and it relies heavily on small cap value. The author argues this is a textbook example of overfitting. Basically, a strategy that looks amazing because it was perfectly designed to survive one specific historical period, in this case, the 1970s.
And what happens when you test this supposedly optimized portfolio against a longer stretch of history? It just falls apart. Look at these 50-year withdrawal rates. Even using the most optimistic historical data, it underperforms a simple baseline portfolio. And when you use the more realistic models, the safe withdrawal rate plummets to well below 3%. It's a total failure for anyone who retired in the 1930s or 40s.
The author really does not mince words on this.
Their direct advice is to stay away from these fashionable, shiny objects that are only cockamamie, overfitted data snooping exercises. They see these complex portfolios as a trap for investors, just designed to look good in a rearview mirror.
So, after all of this, what's the final verdict? Well, that incredible, alluring promise of small cap value, it just doesn't seem to hold up under these tougher, more realistic stress tests. The dream of a 5.5% withdrawal rate, it seems to be just that, a dream, based on a past that is very unlikely to repeat itself.
So what are you actually supposed to do? Well, the author's recommendations are refreshingly simple. First, just keep your retirement portfolio simple. A 75% stock, 25% bond portfolio is a fantastic, time-tested place to start. Don't go chasing a miracle cure from a small cap value tilt. Be really, really skeptical of any strategy that seems perfectly designed for one little slice of history. And finally, keep an eye on overall market valuations to help guide how much you spend.
And that really leaves us with a final thought to chew on. We're so often told that in a complex financial world, we need complex solutions. But maybe, just maybe, the opposite is true. Perhaps in a world that's full of shiny objects and alluring promises, the simplest, most boring portfolio is actually the safest path to a secure retirement.